Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So what I'm going to do in this video is to share with you guys 5 different companies that are undervalued at the moment based on Morningstar valuation. So these companies are currently trading slightly lower than where they are currently where they're meant to be, basically their fair values. So they're under their fair values, all 5 of them. Really high quality businesses. I'm going to share with you some information about each one of the companies, and of course if you're interested in more about the companies, you're going to have to go away and do your own research. As always, I'm not a financial advisor, but I'm just kind of giving you some ideas. And especially right now, considering the stock market has been absolutely crazy, and basically there's a lot of fear in the stock market right now. People are worried about their money. People are worried about the stock market crashing. It has come down quite a bit. If you look at the S&P 500, for example, since the year to date is actually down almost 5%. The Dow Jones is about 3%. The Nasdaq is about 7%, and the FTSE has been doing well, about over 3%, which is quite nice to see for once. So when you look at the 1 month though, it's slightly different ball game. So the last month has not been great to the S&P 500, almost 7.5% down. And the Nasdaq is actually down closer to 10%. So what I'm going to do now is share with you guys 5 companies that are, like I said, that based on Morningstar valuation are trading slightly under their intrinsic values based on Morningstar valuation. But before we do that, as always, if you can join us in the Patreon account, it will be absolutely amazing. You get right now it's a half price. You get a lot of things like all the buys and sales. As soon as I buy or sell basically stock, I share it with the community over there. And then of course the family portfolio, and on top of that you've got all the dividend trackers and ETF trackers and things like that, and then you also have access to the Discord where a lot of brothers are sharing very good practices. So if you are basically enjoying this type of content and you want to be part of the community, join us right now while it's still basically half price, inshallah. Okay, let's get started with the 5 companies that we're going to talk about today. As always, we're just looking at the same information that we always look for. And the first company we're going to look at today is Salesforce. As you can see here, this company is a huge company, 266 billion market cap. It has wide moat, $284 per share. Dividend, they've started paying dividends very recently, so it's 0.56, which is not bad at all. The payout ratio is only 16%, and you'll get $1.60 for every share of this company that you own. And as you can see here, dividend safe to 80%. The profit margin, return equity, return invested capital is decent, and free cash flow right now over to basically $12 billion, and the EPS right now is basically expected to be 9% next year, and revenue growth of 8%. Morningstar saying it's 3 stars right now. $315 per share is where they think the price should be, and as you can see here is $284 per share right now. And just looking at Morningstar valuation side of things, a year to date the stock is actually down 15%. For the 1 year is down about 7%. For the last 6 months is actually up about 12%, but for the 1 month is down over 11%. So this is why we're now looking at Salesforce again, just to see if it's undervalued and so on. As you can see, based on what I've just shown you, it seems a little bit undervalued. And like always, one of the things that we look for is basically growing revenue, and we want to see the basically growing EPS as well. As you can see from here, $6.6 billion in basically 2016 to right now $31 billion of basically total revenue. Look at how much they're spending, just about $8 billion, just slightly over $8 billion when it comes to the cost of that revenue, and basically their gross profit is $29 billion. Of course, they're going to spend a lot of money in research and development. This is a tech company, and basically the net income is about $6 billion. And if you can see here, basic EPS from basically 2016 it was a negative to right now over $6.44. So that's growing in the right direction. One other thing I want to look at is the balance sheet, and I'm interested in the current assets against current liabilities. So total current assets of almost $30 billion against the total current liabilities of $27 billion. So very, very close, but it's still the liabilities is slightly lower than assets, which is basically what we want to see. But when you see total liabilities of $41 billion against total assets of $102 billion, you absolutely have nothing to worry about when it comes to the company. In terms of that, ratings, when we look at the Wall Street expectations, we've got 26 strong buys, 12 buys, 11 holds, and 1 sell. And as you can see here, 32% upside from where we are. $377 per share is where they think the price should be, and right now it's $285 per share. Next company we're looking at today is Uber. As you can see, 148 billion market cap. It has a narrow economic moat. Current price is $71 per share. Of course, it doesn't have any dividends yet. Profit margin, return on equity, return on invested capital is decent, absolutely fine when it comes to especially profit return on equity. Free cash flow over almost the $7 billion right now, closer to $7 billion. They're expecting the earnings to decline about 47% next year, but revenue to increase about 15%, and it's about 3 stars right now. $79 per share is where the price should be, and right now it's about $71 per share. And as you can see here, we've got for the 1 year it's about 9% down, a year to date is about 19% up, for the last 6 months about 6%, but just this month's down about 9%. And as you can see, Seeking Alpha, Analysts, Wall Street Quant is actually saying strong buy, so all of them are green. Basically is a triple buying, if you like. And if we go to quickly just Wall Street to see what they're saying, so we got 32 strong buys, 13 buys, 8 holds, no sales whatsoever. It's a buy rating overall, and as you can see here, $89 per share is where they think the price should be. That's about 25% upside from where we are, which is actually quite nice. Earnings expectations, like I've shown you already, that's 46%. So but December of this year they're expecting the earnings to decline, but after that they're expecting the earnings to basically bounce back up, basically 36%, 24%, and even if we just focus on maybe the first 5 here, 20% and 21% in 2029, which is absolutely amazing. If you think about the following 4 or 5 years, you're expecting basically high growth for this company. And then when you look at the revenue side of it, about 14%, more or less consistent over the next couple of years, which is quite nice. Financials, if we look at the revenue side of things, so $3.8 billion in 2016 to right now $43 billion in the trailing 12 months, which is absolutely amazing. They're spending quite a lot though in terms of the cost of that revenue, so almost $30 billion of that basically is the cost of that revenue. $14.5 billion is the gross profit. And then the net income for this company is right now closer to $10 billion, which is quite nice. EPS has also been growing from the negative to right now positive for $4.71. And the next one we're looking at as basically one of the best REITs out there. This company is a data center company. So basically what they do is they rent out the data centers, and it's because of what's been happening to data centers, the fact that companies like Nvidia's and so on, AMD's, have been doing absolutely amazing with the AI side of things. This basically the stock price went up quite a bit, and I'll show you exactly basically what it's been doing over the last few months. But $81 billion in terms of market cap, so it's a big company. It has a narrow moat, $850 per share right now. They expect it to be basically the price to be $860, so it's basically closer to it is fair valued as right now. Dividend yield of over just 2%. The payout ratio is 49%. Latest increase was 10%, and the 5-year growth rate 12%. The dividend streak for 9 years, you get $18.76 for every share of this company that you own. Safety is 86%. Profit margin, return on equity, return on invested capital is decent. 189 million when it comes to free cash flow right now, which is not great for a company that's basically trading. But remember, this is really slightly different. EPS 26%. Remember, the REITs have to pay 90% almost of their basically net income, if you like, or to as a basically as a dividends and so on, give it back to shareholders if you like. 26% when it comes to expected growth for the next year, and revenue is about 5%, and like I said, it's 3 stars right now. Now looking at Seeking Alpha, for the 1 year it's down about 5%, a year to date is about 10%, last 6 months about 2%, and 1 month is about 9%. So it hasn't actually participated as much as basically the rest of the this is actually genuinely thought it was actually doing a lot better than this. So as you can see, is about for the 1 year actually hasn't done a lot, and in comparison to some of the data centers companies that are out there, the last 5 days about 2% down. So overall it basically seems hasn't done enough for this year. Now looking at the Wall Street expectations, we've got 16 strong buys, 7 buys, 5 holds, no sales whatsoever. Buy rating at the moment, and when you look at it, basically it's about 20% upside from where we are, just over $1,020 basically is where they think the price should be. Earnings expectations moving forward, and remember we're looking at FFOs rather than EPS for this type of companies. 25% And by the way, that should have said this part, that should have said basically FFO for this company, not EPS if you like. Okay, so 25%, 26%, 11%, 8, 9%, 9%. So absolutely amazing. Revenue side of it about 5%, 8%, 8%. Again, really, really good overall. And when you look at the revenue side of it, you can see $2.7 billion to right now $8.7 billion. So that's basically growing, which is quite nice to see. And then of course the net income, again, it's basically what we've seen, how much they've got in terms of, so it's in the millions rather than in the billions. And when it comes to EPS, we can see about $3 to now $8.54. So it is basically growing and it's heading in the right direction, which is quite nice to see. Right, we've got two more companies, and if you haven't liked the video, please like it, subscribe to the channel. Of course, it takes a lot of time and effort to put these videos together, share it with the community, so I would genuinely appreciate if you could do that for us. Next one is S&P Global, one of the companies that I own, an absolutely amazing company. It's done absolutely wonderful over the last whatever years, kind of monopolized the market, them and Moody's. Between the two of them, they basically taken care of that side of the business world. Wide moat right now $479 per share is where they think the price should be, where the price is right now, and they think the price should be 540. So it's slightly undervalued at the moment, and Morningstar is saying it's about 3 stars, so it's heading to probably towards the 4 stars right now. Dividend yield is not great, so it's just less than 1%. You will not be buying this company for the dividend yield, you will be buying for the dividend and appreciation. So the fact that they will increase that dividend every single year. So the payout ratio is only 23%. The latest increase was 6%, the 5-year growth rate of 10%, which is absolutely wonderful. And guess what? This is a dividend king. They've increased this dividend for 51 years. Okay, $3.84 is what you'll get. Safety 99%, profit margin, return on equity, return on investor capital, probably one of the best out there. Free cash flow over $5 billion. EPS is expected to grow this year about 10%. Revenue is about basically 6%, and then right, like I said, it's about 3 stars right now. Now looking at Seeking Alpha, you can see Wall Street is saying it's a strong buy. Seeking Alpha is analysts is saying it's a buy. Quant is saying it's a hold at the moment. A year today is about 12% up, and looking at the a year for the 1 year is 12%. A year to date about 4% down, and last 6 months about 8% down, but just this month about 10% down. Hence why I'm looking at this company again. Now looking at the earnings expectations moving forward for this company, you can see that 10% growth every single year, or 11-12% growth every single year when it comes to in EPS. When it comes to revenue, about 7% every single year for the next 3 years, which is absolutely fine with me. And ratings, like I've said already, a strong buy, 15 strong buys, 8 hold buys, and 1 hold, no sales whatsoever. Strong buy overall, and 27% upside from where we are overall. $608 per share is where they think the price should be. Now looking at the financials, this is important one. $5.3 billion to right now $14.2 billion. And look at that cost of that revenue, just 4% of that $14 billion. Now gross profit over just closer to $10 billion. Of course, they do have research and development. They spend quite a bit on that. And then the net income, $3.8 billion of basically that net income, which is basically quite close to the what you've seen in terms of free cash flow. EPS has grown basically from 4.26 to right now $12.36. So from $4 to $12 is basically the growth for the last 10 years. The final company we're going to look at today, I didn't actually genuinely think this company will come back down to these sort of prices, and this is Arista Networks, and almost 100 billion market cap, has a wide moat, doesn't pay any dividends. $80 per share is where the basically the price is right now. $82 is basically where they think the price should be, and if it continues going down, they'll probably become 4 stars at some point. And as you can see, they don't pay any dividends right now, but profit margin, return on equity, and return on investor capital, probably one of the best out there. $3.6 billion of free cash flow right now. EPS is expected to grow 10%, revenue about 19%. Really great company. I really like the company, but it's, even though it's 3 stars right now, I would actually wait a little bit longer. Okay, let me show you. Seeking Alpha, Wall Street, Quant all agree it's a buy right now. As you can see, for the 1 year it's almost 17% up. Year to date about 27% down a year to date, which is absolutely crazy. So since basically December 31st, so let's call it January the 1st, up until now is down 27%. This is probably one of the reasons why it basically seems undervalued at the moment. 10% when it comes to the last 6 months, and just the 1 month is almost done 30%. Again, just let me put it out there, this is probably one of the most, like, it's quite volatile stock. I've seen it go up like 5% in a day and come back down again, another 20%, whatever, in the 10% in the next few days. I'm over exaggerating, but it is quite volatile stock. Just the last 5 days is down actually 5%. So let's have a look at the ratings side of things. So Wall Street, so 14 strong buys, 7 buys, 4 holds, and 1 sell. And overall it's a buy rating from everyone, and it's about 47% upside from where we are. $117 per share is where they think the price should be. Looking at the earnings expectations moving forward, we've already seen what's going to happen this year, but the next year, so they're expecting about 18.5% and then 21% when it comes to EPS. When it comes to revenue side of things, we're looking at about 19%, 18%, 20%, which is absolutely amazing. So overall it looks really great company. And one of the things that I want to look at now is the financials, in the millions to right now $7 billion over the last 10 years, and look at basically the cost of that revenue, just $2.5 billion. Gross profit of $4.5 billion. Of course, they're going to spend a lot of money on research and development side of things. This company does a lot of the networking side of things. Basically, right now, net income is $2.8 billion. And then basically in EPS, we're looking at from literally 11 cents to right now $2.27 over the last whatever years. So really great company. Is in the right, basically, I like technology companies, as you know, and I like the fact that the stock is actually undervalued, well, coming to undervalued territory right now based on Morningstar valuation. But these guys are already saying, if you've just seen it, all of them are saying it's a buy, and the fact that they think it's about 47% upside from where we are, $117 per share. Again, Wall Street will always be slightly bullish on this stocks, and of course because they get a lot of money out of basically predicting this and that every single week. So that's why I always use Morningstar valuation. So $82 is basically the target. Right now it's 80. If it comes back down to, I don't know, and I've seen it, basically this company it is quite volatile. If it comes to around $70 per share, I think it would be really good position to be a good place to start building on your position. $70 per share. I really like the company. I like basically what they do. And yeah, overall, I might actually do a whole video basically to go over the entire business, inshallah. Just giving you a brief information of each one of the companies. If you enjoy this type of content, please join us on the Patreon account. Of course, it takes a lot of time and effort to put these videos together. And of course, there's subscriptions, things like that we need to pay for. Anyway, the only companies that I own on this list is basically this one here. And as you can see, I've got almost £4,000 on my own money. And Salesforce as well is another one that I own in this on the list that we looked at today. And also yeah, I don't own any of the rest of them. But there you go. That's the companies that I wanted to share with you guys. I hope you enjoyed the content. Have a wonderful day. Assalamu Alaikum.